Hello there, and welcome back to Imaginr. Today we're going to talk about crypto and Bitcoin, what it is, what some of the major altcoins are, what crypto is as a whole. Bitcoin, obviously being the most well-known cryptocurrency, started off as an experiment to decentralize money. But over the last nearly 20 years of its existence has turned into a new financial system involving blockchains, exchanges, altcoins, global trading markets, and it has become a massive part of the financial industry. So in this video, we're going to take a closer look at what Bitcoin actually is, why people believe it has value, and how the broader world of crypto turned into one of the most volatile, yet fascinating financial markets in the world. So here's the problem with digital money. For decades now, if you wanted to create money on the internet, some sort of digital currency, there is an inherent problem to deal with. Digital information obviously behaves very differently from physical objects. If you send a photo over the internet, a document, a file, whatever, it can be copied infinitely without destroying the original. But money cannot work that way. If a digital dollar could be copied over and over again, it would obviously have zero value. There needs to be some amount of scarcity and security behind it. This issue is known as the double spend problem. If someone could send the same digital coin to two people at the same time, the system would obviously very quickly collapse. Traditional digital payment systems solve this by relying on a central authority. When you swipe a credit card, networks like Visa or MasterCard verify that the money hasn't already been spent, and banks maintain centralized ledgers that track balances and approve transactions. Before Bitcoin, there were several attempts to create a sort of native currency to the internet. In the 1990s, there was this guy named David Chow, and he developed DigiCash, which allowed for encrypted digital payments. Another system called eGold allowed users to send digital currency backed by gold reserves. And these projects showed that digital money could technically work, but they still relied on centralized companies. And when regulators eventually shut those companies down, or the businesses themselves collapsed, the currencies disappeared with them. The missing piece, the problem with these original systems, was that a centralized authority controlled the ledger. And what needed to happen was decentralization. Bitcoin appeared at a time when trust in financial institutions was unusually low. In 2008, you all obviously remember the financial crisis. Major banks failed, housing markets crashed, and governments around the world intervened to stabilize markets, but obviously there were some bank bailouts, and it was not done in the best manner. In the US, for example, institutions like the Lehman Brothers collapsed, while others survived because of government bailouts and rescue programs. And for critics of the financial system, of this collapse, the crisis revealed a structural problem. Banks could take massive risks, and then when those risks failed, governments could just step in to prevent total collapse. Meanwhile, millions of ordinary people could lose their job, their homes, their retirement accounts. This was obviously a major problem. And within technology, communities, and circles, a new question began to arise. What if money could exist outside of the banking system entirely? We didn't have to rely on these authorities. Well, this is where Bitcoin started to be conceived. In 2008, an individual or group, no one really knows, I'm sure you've heard the name Satoshi Nakamoto, published a paper titled Bitcoin, a peer-to-peer electronic cash system. And this document proposed a new kind of digital currency that did not rely on banks or payment companies to verify the transactions. Instead of a centralized ledger, Bitcoin would use a distributed network of computers. Each participant in the network could verify transactions using cryptographic rules. All transactions would be recorded on a public ledger that anyone could inspect. And this ledger became known as the blockchain. I'm sure you've heard the term many times. Here's a little bit of random trivia. The first Bitcoin block was mined in January 2009. And inside of that block was a message referencing a newspaper headline about bank bailouts in the UK. And some people took that as a message, interpreting it as a symbolic critique of the traditional financial system. Like the irony of a bank bailout newspaper headline being inside of a Bitcoin block, a decentralized coin, was kind of funny. But I digress. The point is that at first, Bitcoin didn't really have that much meaningful market value. People just treated it as kind of a novelty. It was an interesting idea, but most of the earlier participants were software developers, cryptographers, enthusiasts, and they were experimenting with this new protocol. The example of that newspaper headline in that first Bitcoin block is more to show that it was kind of a meme in the beginning, or a bit of a, like, what is this kind of a thing, right? Nobody really knew what it could do at the time. But where it started to become interesting was when one of the first few transactions started to happen. And one of the most famous early Bitcoin transactions I'm sure you've heard of was in 2010 when a guy offered 10,000 Bitcoins for 2 pizzas. At the time, those coins, that transaction was worth about $40. But today, obviously that amount of Bitcoin would be worth hundreds of millions of dollars, and I'm sure that guy will never live that down. But the importance of that transaction it was not the price, it was proving that Bitcoin could function as a medium of exchange between two people online. Small communities began forming around the technology. Forums like Bitcoin Talk hosted discussions about mining software, wallet security, potential use cases for decentralizing money. People started to talk about it. And around the same time, cryptocurrency exchanges began appearing. People had to have a way to actually buy the Bitcoin. And so platforms like Mt. Gox, which was an exchange based in Japan, allowed people to trade Bitcoin for traditional currencies like US dollars. This effectively created the first real market price for Bitcoin, and it introduced the asset to a much wider audience of people. People could now purchase it on this exchange. One of the most distinctive characteristics about Bitcoin is that it has a limited supply. The protocol caps the total number of Bitcoins that will ever exist at 21 million coins. And this is quite a fundamental difference. Unlike traditional currencies, which can be expanded and printed by central banks, Bitcoin's total supply is written into the software. New Bitcoins can enter circulation through mining rewards given to computers, but there will only ever be 21 million coins. And even so, with Bitcoin mining, those rewards decline over time. Roughly every 4 years, the mining reward is cut in half in an event known as halving. When Bitcoin launched in 2009, miners received 50 Bitcoins per block. That reward later dropped to 25, then 12.5, and today it's about 3 Bitcoin per mining block. And people that are supporters of Bitcoin argue that this predictable supply creates digital scarcity. And obviously scarcity drives up value and price. In contrast to traditional currencies, where governments can expand money supply during economic crises and just print more money, Bitcoin supply is transparent and mathematically fixed. And this is why for many investors, people compare Bitcoin to gold, because it has an inherently defined supply. Gold is not a perfect comparison. You can always mine more gold. There's technically gold in asteroids, but it's a lot harder to produce more of it than, say, paper money. So if Bitcoin has no central authority when it's verifying transactions, there is this question. Who actually keeps the system running? Who's running it? How is it operating? The answer is in the network of participants known as Bitcoin miners. I've mentioned this term now several times. What is Bitcoin mining? It is the process through which computers verify transactions and add new blocks to the blockchain. These computers are effectively competing to solve complex mathematical puzzles. And when a miner successfully solves the puzzle, they earn the right to add the next block of transactions to the blockchain. In return, the network rewards them with newly created Bitcoin. And I'm sure you're asking, well, what's the point of this? Who cares if they're solving mathematical puzzles? Why is this valuable? Firstly, it incentivizes people to dedicate computing power to securing the network. Without Bitcoin mining, there would be no mechanism to verify transactions or prevent fraud. They are incentivized to keep going, keep mining, which creates more security through more computing power. And secondly, it introduces new Bitcoin into circulation in a controlled manner. In the early days of Bitcoin, mining could be done on a normal home computer. Enthusiasts could just run software on laptops or desktops and earn Bitcoins as a hobby. But as the network grew, the puzzles became more difficult to solve. And nowadays, Bitcoin mining is an industrial operation. There are large-scale mining facilities existing all around the world that really just look like massive warehouses, like data centers. And these facilities contain thousands of specialized computers called ASICs that are specifically designed to mine Bitcoin. That is all they do 24 hours a day, trying to mine Bitcoin. And some of these facilities consume as much electricity as small towns. This is a massive power draw. And that has obviously sparked debate about whether Bitcoin's security model is sustainable in the long term. Why would we be dedicating so much computational power to this if it is so resource intensive? But again, I will remind you that supporters of Bitcoin, the whole point of this is that they say that it is necessary to create a secure, decentralized financial system. The value of a decentralized currency, one that is not going to be deterred by a centralized authority, is worth it. And so as Bitcoin became more valuable, mining turned into a global industry. In the early 2010s, mining operations began concentrating in regions with cheap electricity. If it's going to be that expensive to mine, you obviously want to put it in a place where electricity is cheap to get. And so for many years, a large portion of Bitcoin mining occurred in China, where coal-powered electricity and large-scale infrastructure made mining relatively inexpensive. And at its peak, China controlled a majority of the network's computing power. However, this is interesting, in 2021, the Chinese government banned cryptocurrency mining outright. So effectively overnight, large-scale mining operations shut down or relocated to other countries. Mining operations moved to places like the US, Canada, and parts of Central Asia. Today, the US hosts some of the largest mining farms in the world. In Texas, companies operate massive warehouses filled with rows and rows of specialized mining machines. Again, these facilities are designed to run continuously, every single day, 24 hours a day. And this just goes to show that when you have a decentralized currency like this that is not run by one company or one bank or one government, it can shift quite easily. It can relocate. It can adapt. And that is a valuable property of Bitcoin. As Bitcoin has matured, it has evolved in its role. In the early years, Bitcoin was treated as a digital payment system that people could use for everyday purchases, like that guy that bought a pizza with 10,000 Bitcoins, right? But the volatility and the transaction speed of Bitcoin makes it less practical for daily commerce than people would like to believe. Over time, a new narrative emerged that Bitcoin could be more treated as digital gold. Gold has existed as a store of value for thousands of years. It's scarce, it's difficult to produce, it doesn't corrode easily, it is widely recognized, it has always been the mark of wealth. And supporters argue that Bitcoin shares these same characteristics. Its supply is limited, mining it requires significant resources, and the asset can be transferred globally without relying on banks. And for this reason, many investors began treating Bitcoin as a long-term store of value rather than a payment currency. Large financial institutions eventually began acknowledging this narrative. Think hedge funds, asset managers, people that have an interest in holding Bitcoin. They started allocating small portions of their portfolios to Bitcoin. And companies like Tesla, for example, purchased billions of dollars worth of Bitcoin during 2020 and 2021. While the comparison to gold is controversial, it is not a perfect comparison. The narrative has helped Bitcoin transfer from a niche technology for transactions to more of a recognized financial asset. And one way to understand Bitcoin's value is through network adoption. The more people who hold and trade and accept Bitcoin, the more useful the network becomes. At the end of the day, things are only valuable to us because other people use them. If nobody is using Bitcoin, nobody cares. But the more people that adopt it, the more people that have Bitcoin, the more people want to have it. It is human psychology to want what other people have. When financial crises happen, when major events happen in the world, Bitcoin doesn't always fluctuate with those events. It is an independent currency. It's possible that when I say this will already be outdated soon, but notice, for example, right now with the war in Iran. Notice how volatile oil prices have been, how things can massively fluctuate with events like this. Bitcoin hasn't changed that much. Just because one event is happening internationally does not mean that a decentralized asset like this will be massively affected. It can affect it, but it often operates on a separate wavelength, which has its pros, but it also has its cons of being unpredictable. And so for investors, people that want to hold Bitcoin, these factors tend to turn it into more of a speculative asset. Some people see it as a hedge against inflation, like gold. Others view it as a long-term innovation that could reshape financial infrastructure. Nobody knows what's going to happen, but the belief in Bitcoin has played a major role in driving its adoption. It is the most discussed cryptocurrency, it is the most well-known, and that inherently has value. Whether or not it becomes a global store of value, whether or not it goes to $1 million a coin, like some people want to believe, its creation has triggered something much larger. Bitcoin has demonstrated that decentralized digital money can function in the real world. Once people start to believe in that concept, developers begin starting projects that use cryptocurrency and try to create new technology. Think about how many coins there are. Bitcoin is just the top of the charts, but there are thousands of altcoins and projects. Some focus on improving transaction speed, others introduce smart contracts, which we'll talk about later, and others try to create entirely new financial applications built on blockchain infrastructure. While there are thousands and thousands of altcoins that do absolutely nothing or are just scams, pretty much, there are many that try to expand the concept of blockchain, like Ethereum, Solana, Cardano. Instead of just transferring value, these networks allow developers to build new decentralized financial systems. They build off of the blockchain. In many ways, Bitcoin has acted as a prototype. It proved that decentralized monetary networks can exist and that other projects can follow in its wake that are built upon that original idea. Pretty much as soon as the system began operating, developers started asking, what else can we use this technology for? What else can the blockchain be used for? Bitcoin, again, was primarily designed as a monetary system. The scripting language behind it is intentionally limited, which helps keep the network secure and predictable. But this also means that building more complex applications directly on Bitcoin's blockchain is pretty difficult. And so developers doing what they do, they imagine a broader platform. What else can blockchain do than just transfer money? What if it could run programs, execute agreements automatically, or allow developers to build new applications on top of it? And so this led to the creation of altcoins. The most important altcoin, probably the second most well-known cryptocurrency, is Ethereum. This was proposed in 2013 by Vitalik Buterin, and Ethereum was the first coin to introduce smart contracts. A smart contract is essentially a program that runs on a blockchain. Instead of relying on a bank or a lawyer or some intermediary to enforce an agreement, the contract executes automatically when certain conditions are met. For example, a smart contract could automatically transfer funds once a shipment arrives, or it could distribute payments between investors, or execute financial trades based on market conditions. It's not so dissimilar from the idea of just a bot, like a Discord bot or something, but it is based on blockchain technology. Ethereum was proposed in 2013 and then launched in 2015 and quickly became the second largest cryptocurrency network after Bitcoin. And unlike Bitcoin, which primarily focused on being a store of value and payment network, Ethereum functions more like a decentralized computer that anyone can use to run applications. And this idea dramatically expanded upon what Bitcoin technology could be used for. Ethereum made it easy for developers to create entirely new cryptocurrencies on top of its network. Ethereum is not just another coin, it is a network. And the cryptocurrencies that are built on top of Ethereum within that network are often called tokens. Instead of creating an entirely new blockchain from scratch, developers could launch a token that used Ethereum's infrastructure, and this dramatically lowered the barrier for entry to creating new digital assets. During the late 2010s, this capability triggered an explosion of new cryptocurrencies. Projects were raising billions of dollars through token sales known as initial coin offerings, or ICOs. Pretty much the same idea as IPOs, initial public offerings when companies go public on the stock market. And investors in these tokens would purchase the tokens in the hope that these projects would grow into valuable platforms. It remains a very speculative way to invest. Some projects focused on building decentralized applications, while others attempted to create new systems, gaming platforms, or digital marketplaces where goods could be bought and sold. Think NFTs. And while many of these early projects failed, the ICO boom demonstrated how quickly blockchain ecosystems could expand once developers had the tools to create new assets. As the usage of crypto grew, another issue became clear, and that is speed. Bitcoin's network processes roughly 7 transactions per second. Ethereum is faster, but still much slower than traditional payment networks like Visa, which can process thousands of transactions per second. And this limitation encouraged developers to create new blockchains optimized for performance. If crypto was ever to be used as a competitor to traditional payment methods, a way to actually use it to spend money, then it would need to be a lot faster than 7 transactions per second. Solana, for example, is designed to handle thousands of transactions per second, and this speed allows developers to build applications that require higher input. If people are to buy things online with crypto, it cannot be incredibly slowly if you're trying to trade. It has to be fast. And so these newer networks created intense competition within the crypto ecosystem. Each platform attempted to attract developers, users, and investors by offering better speed, lower fees, or improved security. And so as a result, the cryptocurrency landscape quickly evolved from a single project into an entire ecosystem of competing blockchain networks. One of the most practical innovations to come from the altcoin system is the stablecoin. Unlike most cryptocurrencies, which can fluctuate wildly in price, stablecoins are specifically designed to maintain a stable value. Many stablecoins are pegged to traditional currencies such as the US dollar, and this idea is simple. 1 token equals $1. Stablecoins allow traders to move money between cryptocurrency exchanges without converting funds back into traditional bank account. And they also make it easier for users to store value inside crypto markets without being exposed to extreme volatility. You can just put your money in a stablecoin and just keep it there in the market without having all of your money invested in Bitcoin, for example, which could be much more volatile. Some of the largest stablecoins today, such as Tether, which is USDT, or USD Coin, which is USDC, they process billions of dollars in transactions every day. And in many ways, stablecoins essentially function as digital cash in crypto. For traders, they provide stability. For exchanges, they provide liquidity. It can be used at any time to purchase or convert crypto. And for the broader crypto market, they act as a bridge between the traditional financial systems and decentralized networks. Now, this video was really meant to just be a broad overview of what mainly Bitcoin is, and also a little bit about stablecoins. I don't want this to be an overly long video. If you guys want to hear more specialized talk about crypto, I'm happy to make more videos, but let's keep this brief. It's been over a decade of crypto existing, at least in the major mainstream way, and the long-term role of crypto remains quite uncertain. Some people are die-hard believers that blockchain technology will revolutionize the world, and other people think that it's just a fad. There are a couple of futures to consider as we wrap this up. One is that crypto could integrate more with the traditional financial system, with banks or payment networks adopting the blockchain technology while maintaining its regulatory framework, the heavily centralized framework. Another possibility is that decentralization becomes much larger. It could become the new infrastructure of the entire world as we know it when it comes to finance. And it's also possible that the thousands and thousands of altcoins that we all know about disappear as speculative interest fades. Regardless of the outcome, cryptocurrency has fundamentally changed how people think about money and ownership and finance on the internet. It started off as a very niche, speculative, weird experiment and has now become a part of the global market. Whether you are an optimist or a pessimist on crypto, it is undeniable that it has changed how we think about money. So I hope you thought this was interesting. Again, this is just a broad overview of what Bitcoin and some of the stable coins and altcoins are. If you want to see more information, I'm happy to make more videos in the future. I'll see you in the next one.